I'm going to speak a little bit about markets and then put products in that market context. But I want to kick off, first of all, just with a little word of caution. I think when we think about retirement, when we think about the level of interest rates that you can get in the market today, it's very easy and very tempting in any area of life, actually, to have our expectations of what happens in the future be very, very shaped by our experience in the past. And if you think of interest rates, and what I'm showing you here is interest rates going back 2014 and jumping in 10-year gaps, back the previous 10 years, and just looking at where the Monetary Policy Committee had kept base rates over those 10-year periods. When I first started in the city, base rates were around this kind of 6% level. Those of you that have maybe been looking at financial markets for slightly longer will remember even higher rates than that. And there is a risk when you come to think about income products or retirement products that perception of where interest rates have been in the past can shape your expectations of return for a very low level of risk. So as we come to unpack this idea of income and investment in income, I just want to put a risk out there that maybe we're allowing the past to shape our expectations a little bit too much. We just heard previously about risks in terms of the investment world as well. We spend a lot of time as an asset management community thinking about the behavioral risks that we can be prone to, the risks that the traps that we might fall into. And one of them, we've already heard it mentioned, is looking at bond yields. And if you look at bond markets today, and what I'm showing you here is long-dated US Treasury bonds going back to 1980, you can see that the interest rates on US bonds today are at extremely low levels. And there has been a lot of talk in the press about, is this a bubble? Is it a bubble that's about to burst? And I want to put to you that, again, for us in the investment community, there's a risk here that you look at that sliding graph and say, well, it's a bubble that must burst. But actually, as we start to think about where the economy goes next, we're living through some quite fundamental changes in terms of the economy, in terms of demographics, that maybe would argue that these level of interest rates could stay lower for longer. Let me take that graph and just press the button and turn over the page and put inflation on top of that graph. Same story there. We've lived through a time in which inflation has really come down very dramatically since where it was at the end of the 70s. We're all seeing what's going on with the oil price at the moment, with that being very depressed. But you're seeing it in other commodities as well, whether it's copper or sugar or wheat. You're seeing a lot of commodity prices pushing inflation down. It's quite hard to see what changes that pattern very quickly. And I would argue that we're actually in a world where you're having to reconfigure a little bit what our growth expectations and our inflation expectations should be for the future. We're starting to see that already. I'm just throwing this graph up here, which is the change in official forecasts for growth for 2015 between the beginning of the year and today. And these are forecasts that are put out by very eminent economists. So if we take the US, for example, since January the 1st this year, on average, US economic forecasts for the US have come down by 1% in terms of where people expect growth to be. So people have gradually ratcheted down that expectation for growth. Some countries have really undershot to the downside, like Brazil. You're hearing a lot more in the press now about concerns around emerging markets, be it Turkey, be it Brazil, scope for political unrest or emerging market turbulence coming through. Some have surprised to the upside. Europe's done a little bit better than we thought. Spain has performed well. But on the whole, there's just a little bit more pessimism seeping into markets, and perhaps people starting to question whether actually there's a new normal of growth just being slightly lower than it has been historically. Some longer-term trends are shaping that thinking as well. One thing that we've really seen in global economies since the global financial crisis is that the level of debt has gone up a lot. You've heard a lot about deleveraging, but we haven't actually seen it in practice. If you look here, Q4 2007, in terms of the amount of global debt in the system at around 142 trillion, that has increased in 2014 by 57 trillion. We've seen a lot of that come through from emerging economies. So China is probably one of the standout examples. The amount of debt in China has increased by 4 times since the global financial crisis in 2008. So a lot of that growth in debt has come from emerging rather than from developed economies. And a lot of it's come into the government sector as well. So governments today are bearing a lot more debt. If I just give you the high-level number there, since the financial crisis, we've seen debt increase by 5% a year. That's quicker than growth. That's important because very highly indebted economies tend to have slower growth. Money just changes hands less quickly in a highly indebted world. Unfortunately, highly indebted worlds are also a little bit more prone to crisis, so they're slightly less stable worlds. So this increase in debt levels is something that we do need to be concerned about and do need to factor into our expectations of growth going forward. We've heard already today about the fact that we're all living longer. The other side to that equation is that actually people are having less children in many parts of the world. This is looking at fertility rates in 1970. And again, I'm just going to flick over the page to 2014. The blue here is where people are typically having 1 to 2 children or 2 to 3 children, which is below replacement levels of children in most countries. So this is 1970. As I turn the page there, you can see that in 2014 now, a large number of countries, and actually the majority of countries, are operating below replacement levels. That's why it's interesting to have this whole debate around migration at the moment, the fact that maybe Europe does need more younger people coming in, whether you buy into that argument or not. The fact that remains that group of people that are between about 24 and 52, who are the wealth generators, that group is really shrinking. And that does have an impact on growth going forward. One of the things that we're very focused on is just how people consume as they get older. This is looking at the UK and looking at consumption patterns as people do get older. And the big message that comes from that graph is whether you're spending on food and drink or recreation or travel, as you get older, you just spend a little bit less. You have the stuff that you need. And therefore, the contribution of consumption to growth starts to slip back. I don't want to sound too bearish, but or too negative, but I just want to put out there that there are a few signals that would suggest that we are living in a world going forward where growth is just going to be that bit more subdued and inflation's going to be lower. In that context, we need to be quite careful when we're looking at funds that are offering you rates like 8%. We need to be digging into that and saying, is that a realistic interest rate to be offering me if base rates are 0.5% and likely to stay there for a long time? And actually, while I might have got 8% 20 years ago without taking much risk, today you have to take an awful lot of risk to be getting that kind of level of income. You can actually find that bundled into some of these income maximizer funds, you've got some quite niche areas like aircraft leasing or unlisted securities. In order to grasp that yield, you can see investors taking more and more risk. So it's very important to get under the bonnet. It's also very important to think about the balance between income today and total return in the future. Let's think about an investment, a hypothetical investment of £10,000 that you invest over 5 years. If you take the average equity income fund that you could go and buy in the market, the average yield you can get today is around a 4% level. So you could get a 4% yield coming at you on an annual basis. For a lot of the income maximizing type funds out there, they will offer you higher yields. Maybe not quite 8%, but there are quite a few of them out there that are offering you 6, even 7%. And they will pay that to you on an annual basis. That's part of the equation. The other half of the equation is to be asking how much are they dipping into my capital in order to be paying out that yield. And if we compare capital growth across those two types of funds, one which I would argue is giving you a more realistic yield, and one which is giving you quite a boosted yield. Capital growth for your average equity income fund is still quite healthy at over 5,000 in addition to the annual income. For your income plus funds, you can see that capital growth really drops down. So you might have been enjoying a very nice income in the present, but actually that's starting to eat into your future total return. And as we look at total return, so that's income plus the capital, actually of these more exciting income maximizer type of funds, there are none of them in the top quartile, so in the top 25% of performers. So very important to be asking that question when you're looking at income funds: am I sacrificing return tomorrow in order just to have a steady cash flow today? So breaking down that total return is quite key. There's a risk here that I sound a little bit too negative, and I don't want to do that. The answer here is not just to put your money under the bed. And if you look at the long-term patterns of markets, even if it feels a little bit uncertain at the moment, and there are a lot of sort of areas of turbulence out there, you have to keep this long-term picture in mind. And what I'm showing you here is long-term returns of different asset classes after inflation. So we axe out the negative impact of inflation. So if we take the 10-year view, actually you're slightly negative after inflation if you've just sat on cash, because inflation's just going to eat away at your spending power. Whereas be it in equities or bonds, you're able to generate a decent positive return. You do also need to be able to switch between those two. So if you look at 2014, for example, a slightly negative return after inflation. So you do want that flexibility within a fund to think, should I be in equities, in stocks, in shares or in bonds? You want to be able to move between the two. That flexibility is important in the short term. And in the long term, you do want to stay in the game. You want to stay in markets to make sure that you're beating that basic cash return. Also, just to put out there that if we look at the basic economic numbers, they're not too bad. What I'm looking at here is, if we take the left-hand graph, just basic levels of manufacturing activity across the key economies. These we call the Purchasing Managers Index, and 50 is the key level. If you're above 50, you're growing. If you're below 50, you're contracting. And most economies are still in that above 50 level. So while there are reasons to be a little bit more cautious on growth going forward, it's not Armageddon. And growth is still ticking along okay. So you do want to still stay engaged in equity markets, but you want to be doing it with some flexibility to think about what that equity allocation and fixed income allocation should look like. I want to put it to you that as you think about income funds, in our view, the best way is to keep it simple, to keep it very transparent, and to know what the underlying building blocks are. If you're buying an income fund, that really ought to be a foundational investment. If you want to decide you're going to take a bit of a punt and put on some Indian equities or some aircraft investment on top of it, fine. But these income funds need to be foundational, and that foundation needs to be transparent and straightforward. So two key building blocks, equities and bonds, will allow you to navigate different types of market environment. They'll also allow you over time to beat that inflation and the corrosive impact that has. Two things which for us are very important in the way that we manage income product. The first one is really getting into the detail. So yes, it is about thinking about your overall asset allocation, but it is also really about drilling into the detail of which names you own. So for example, in the supermarket space, we've been very negative on Tesco, very concerned around accounting, very concerned around actually the overall picture for that name in a very cost pressurized environment. But on the fixed income side, we really like Morrisons. We like Morrisons because they're reducing debt and they have a good property backing for the bonds that we invest in. So it's really getting into the granularity and saying which names here can throw me out a decent income and can provide some good fundamentals. So you need a company that's going to be doing its analysis, that's going to be getting in front of management, looking them in the eye, and asking them the tough questions to work out whether they really have a strategy going forward. So that active skill and that detail is the first very important thing for us in terms of managing product. The other really important thing is downside. Just looking at this quote here, people might tell you that they're very fixated by income, but at the end of the day, it's pretty ingrained in all of us that we all hate losing money. And just having that focus on downside and avoiding that pain of loss for us is key for all of our clients. Making sure that we're managing downside is very critical, particularly for these kind of investments that are so foundational to a lot of our pension fund money. To throw out one big example at the moment, we're incredibly focused on China right now. It's really hard to get a handle on where Chinese growth is. You can look at the official numbers, but actually how much are they actually telling you? So we'll look at things like this, which is it's called the Premier Li Index, and it's an index that Premier Li put together actually before he became Premier, looking at some slightly more concrete signals of growth. How much electricity is being used in China? What's the level of rail freight activity? Those real measures of economic growth. They would suggest to us that Chinese growth is probably actually tracking closer to 3% than the official number of around 6 or 7%. So focusing on the downside, keeping a strong eye on the risks and making sure we're trying to anticipate them, for us is really key to the way that we're thinking about these products. Two key things in terms of actually which products you invest in. The first is a basic one, but people really matter. For our distribution fund, our enhanced distribution fund, we have Alistair and Reese who co-manage that, one with an equity background, one with a fixed income background. What's important to us is that they're talking to each other. They're sitting there, they're discussing the different sectors, they're almost arguing for cash, who's going to get that share of the cash within the fund to make their investment. They're both from very analytical backgrounds, so they're both very expert and experienced in getting into the detail and really drilling down beyond the superficial level of investment. So the people do matter, and you need to know that those people are operating functionally as a team. The other thing that really matters is product. There's such an array of income funds out there, and being able to drill down and ask the right questions is very important. Here again, I'm just showing you a very high income fund, an income boosting, maximizing fund. Again, going back to 10,000 invested on a 5-year view. And you can see here again quite a nice attractive income that you would get over time. Capital growth is quite low. Although you're getting a nice payout on a year-by-year basis, your capital return is quite low for these kind of maximizing products. Your total return is reasonable, but clearly it's skewed towards your annual or your quarterly payments rather than towards the total return experience. So you need to be asking that question: how is that total return split between income and capital? You also want a handle on how volatile the fund can be, how much could you lose. Maximum drawdown is looking at sort of peak to trough experience, so the biggest drop the fund has ever had. Important to know in the life of a retirement cycle, actually what could you be exposed to in terms of maximum loss. And those are quite punchy numbers for some of these funds that are taking a lot of risk in order to give you that secure income. For us at Jupiter, we have a suite of funds that are in the income range. It's very important for you to be able to pick what suits you in terms of risk profile, and also important to be able to change. Your own circumstances might change, and you therefore might want a slightly more or less risky fund to be investing in. This is one of our funds with an equity bias, steady income over time, much stronger number in terms of capital growth, and a good total return package overall. But you can see the income and the capital growth there much more balanced, much less skewed to just focusing on paying out the income in the short term. and the volatility and maximum drawdown for our funds, which again are quite simple. We're just using these 2 key building blocks without getting too funky in terms of add-ons. That helps to reduce your overall risk. We do also have funds with more of a bond bias. You can see straight away there the risks are much lower, your risks of having a sharp drawdown. But nonetheless, you're still able to get a decent income and capital growth, again quite balanced between the two, although the numbers are just that little bit lower. Time horizon is very important here as well. If you are looking to invest in a longer time horizon, you might be happier to have a fund with more equity risk in it because you've got more time to bear the fruit from equity income. In a shorter time horizon, you might prefer to take less risk and just have that steady balance between income and capital growth. So always asking that question, what is my time horizon for investment here? Or maybe blending the 2 funds between a shorter and a longer term time horizon. Here are the 3 funds that we have in our suite, just to pop that out there and show you the difference in yield. So around 3% for the more bond-biased fund. We are trying to be real and straight with people in terms of the kind of income we think we can generate. 4% is a less juicy number, but we would prefer to be upfront about that and protect capital as well. I need to stop talking. Hopefully that's given you a few thoughts around markets, around being forward-looking in terms of expectations and real in terms of how to achieve that. Thank you.